Good morning, everyone. Ladies and gentlemen, I hope you can all hear me well. And welcome to the first iGravity webinar. I'm very pleased to introduce you to our first impact investment solution event today. And we are going to talk about green bonds, how to optimize impact and return. So hopefully you as a participant will get a better view and some insights of what you need to look at if you plan to invest in such bonds. But before we start, I'm going to give you a very brief introduction on iGravity for those who don't know us so well. So iGravity was created in 2017. It's a 100% dedicated impact investing company. And we have three core pillars of activities. The first one being research and partnerships. We advise on innovative finance and use of outcome-driven financial tools. Our second pillar is impact venture. We invest in venture capital impact enterprise and advise on mandates of such investments. And our third pillar, and particularly the one representing today, is investment solution, where we build impact investment products. And in May last year, we launched our first iGravity Impact Investing Index, which is a diversified impact investment solution for institutional investors. So today, I'm actually surrounded with two experts in the field of green bonds, and I'm going to introduce you the speakers. So we have Lili Hocke. Lili Hocke manages the Sustainable Financial Services Opinion Services of Sustainalytics globally. She is responsible for the development and enhancement of impact and opinion products for loans and capital markets. So more concretely, she looks at green, social, sustainability bonds and loans, as well as sustainability-linked financial instrument. And from iGravity, we have our second panelist, Itamar Ahrenbeck. Is an impact investing specialist in the investment solution team. He is in charge of deal sourcing and due diligence on fixed income and equity space. And Itamar previously worked in the private equity and private debt financial advisory, having co-founded an advisory firm where he advised Latin American SME and startups. Well, so welcome to my panelists, and happy to start. And maybe before I give you also the chance to Lili to introduce Sustainalytics for those who don't know it.
Great, yeah, thanks, Frédéric, and good morning, everybody. As already mentioned, I'm working on the opinion services at Sustainalytics. So Sustainalytics is a second-party opinion provider, the largest one globally. We are also leading in the space of CBI verification. You will get to know over the presentation what exactly that is. We have been on the market since 25 years, but more as an ESG data provider for investors, and since last year, part of the Morningstar company.
Thank you, Lili. And before we start, maybe a few housekeeping rules. So you're all on mute and there's no video enabled for you, but you can raise your comments and questions through the dedicated function in the Zoom panel. And we'll certainly address these questions towards the end of the seminar or potentially during, depending what these are. So now I have the pleasure to start with green bonds. Green bonds is already quite a few years old, and maybe a brief definition for all of you, so we speak the same language. For us, green bonds are bonds which include a commitment of the issuer to allocate proceeds to activity that have a positive environmental impact. And with that, I think I would give the word to Itamar first. So Itamar, if you can give us maybe some lights on the market, and maybe highlight a few characteristics of that.
Sure, thank you, Fred. So I'm going to start by presenting a bit the characteristics of the curve of the green bond market and how it's been evolving, both in terms of impact, so of greenness, and in terms of returns. So let me share my screen. So if we just look at where we come from, the green bond market has been growing quite steadily and fast over the last 5-6 years. by over 40% on a compound annual basis. And last year, at the end of 2020, it just reached over $1 trillion in total issuances. And yeah, so we saw a small dip in from 2019 to 2020 in green labeled bonds. But then if you consider other types of sustainability linked bonds that have emerged, particularly last year, we would be up quite substantially to around $500 billion for 2020. So it's a fast-growing market and something that's more and more on the radar of investors. In terms of market segmentation, so the bulk of the market is in developed markets, with almost 3/4 issued either in the US or the European Union, followed by China with around 12%, and then other more emerging markets, which still represent a relatively small portion of the market. And then you have also some development banks and other types of government-backed entities, which represent 5% of the market. And if you look at what those bonds are actually used for, you have three main areas, which are the green transport, such as electric vehicles or railway. Then you have buildings, so that's mostly in terms of efficiency in building heating or such investments. And then in energy, so that is renewable energy and other energy efficiency programs. And yeah, maybe one of the reasons why issuers focus on those is because those are the actual most mature, I mean, those have the most mature technologies. And so it's relatively easier for issuers to get a positive ROI from investments in such categories. Whereas if you look at land use, for example, which would include agroforestry or sustainable farming, it's more difficult to get a positive ROI on such investments. If you look at the definition of green, something that raises a lot of questions in the general public and around investors. So you have three main categories of way of seeing it. So you have first the green bond principle, which kind of give you the basis of what a green bond should be. So they just say that it should be used to invest in environmental projects, so environmental enhancing projects that would decrease the footprint of the company or the issuer in general. Then you have the Climate Bonds Initiative, which have developed a climate bond certification scheme, where they go in a more scientific way into what a green bond is, because they look at whether the actual investment is aligned with the Paris Agreement. And finally, you have the actual regulation. So you have the EU taxonomy and the Chinese regulation, which say what can be or not called green under their legislations. And famously, I mean, we've had some issues in China with regards to coal, for example, where they would allow some efficiency programs in coal to be called green, whereas for most investors in the European Union and mostly everywhere, they wouldn't agree that it's eligible. Another way of seeing it in a more intuitive way, maybe, is just to split the levels of greenness of investments. So you have on one side the light green projects, where you could put the projects which have not, which don't have currently an alternative to, I mean, a really green alternative to the status quo. So, for example, in the shipping industry, you don't have a fully green shipping technology yet. Then you have what I call a step in the right direction, but that is not there yet. So here you could consider hybrid cars, which still use some fossil fuel. And on the right side, you have the holy grail of greenness, which are fully aligned with a low carbon economy, such as renewable energy. But the issue that we have here is, even though those projects could be dark green, you still wouldn't be looking at whether the actual business of the company is positive or not. So as an example, at the end of last year, Coca-Cola Mexico issued a green bond for a project that was quite, that decreased quite substantially the effects of the company on the environment. But then it's a question for the investor to decide whether they think that it's actually a credible green bond issuer or not. And finally, just to give you some sense of the how green the market is in general, in 2020 you had around 13% that were certified climate bonds. So that is fully aligned with the Paris Agreement. Then you had 50% that were aligned with CBI, but not actually certified. And you still have a big chunk of the market, which represents around 40% of the green bond market, that is not aligned with the Climate Bonds Initiative. So that means that they wouldn't be aligned with the Paris Agreement and will represent more than 1.5 degree global warming. Thank you.
Thank you, Itamar, and thank you for this short overview. But what about investors? Where can they find attractive green bonds to invest?
Sure, yeah, that's an important question, obviously. So green bonds are fixed income vehicles, and as we know, the yields are currently very low, mostly in developed economies. So if you just look at the broad green bond market, it's not very attractive for investors. So the ETF that takes the broad green bond market is yielding around 0.3%. But then we see some pockets of opportunities, particularly in emerging markets, where you have, for example, the corporate yield spread is currently at 3%. So you have to be selective, obviously, because you have different types of risks when investing in emerging markets. But if you look at exporter companies that have not been hit particularly hard by the COVID crisis, you have some opportunities there.
Excellent. So we see that the sector is in full expansion. There's already a huge variety of green bonds, and I remember a few years ago when I was looking at some of them, was always asking myself, how green is green? Now I have the chance of having Lili here and not really asking you directly that question, but Lili, could you give us a bit of a highlight? What is really behind the framework to assess the green bonds? What type of thresholds and standards are in place, and are these the same for all the industry sectors?
Sure, yeah, happy to elaborate a bit on that. So just recapping a bit, so Itamar already touched upon that. There are several different, let's say, names in the market, the Green Bond Principles, Climate Bond Initiative. Just want to make sure it's fully understood what is actually behind those, what they do and what they don't, and how much they go into these thresholds of sectors. So as Itamar already mentioned, the Green Bond Principles really set the high-level expectations of investors to the issuers. They're administered by the International Capital Market Association, and they really just say, okay, your proceeds need to go to projects that are that have a positive environmental impact. They provide example categories such as renewable energy, clean transportation. They also have requirements in terms of, let's say, how you manage your proceeds, how you select the projects, and like the reporting that you do in terms of impact, but they don't really give you any thresholds. So an example that demonstrates that is that geothermal energy clearly falls within the realm of renewable energy, but some of the geothermal sources actually emit in the scale of fossil fuels. So obviously that's not really an improvement in terms of greenness. And these nuances are actually then, need to be made by the second party opinion providers. So we internally have developed a taxonomy that addresses all kinds of sectors and looks at where can we really say there is an impact to be achieved or not. There are also a lot of other taxonomies. So CBI has its own taxonomy. They are really looking at climate change. That is really their focus, alignment with the Paris Agreement. Sustainalytics internal taxonomy looks broader also at other themes, such as also social sustainability. We have the EU taxonomy that Itamar also already talked about. And while CBI and the EU taxonomy try to align, there are at the moment certain differences, and we need to see how that plays out. But both of these taxonomies set very strict thresholds for what is eligible and what is not eligible. But however, let's say we do see also other taxonomies, such as the Chinese Green Bond Catalog, which has very different, let's say, thresholds. The EU taxonomy really tries to look at which projects have a significant, let's say, benefit towards the 6 EU environmental goals, objectives. And so that can also be broad. It will be broadened over time. At the moment, they're looking at climate change and climate change adaptation. Now, within these sectors, then there are obviously different technologies that can lead towards really making an impact in terms of climate change mitigation. Often we see thresholds being set in terms of carbon emission or greenhouse gas emissions. So the Climate Bond Initiative sets a threshold for that, as well as the EU taxonomy. But we do also see that those sectors that Itamar already touched upon that are not yet there or don't have readily available green technologies, but are desperately needed to make really the cut towards climate change and aligning with a below 2 degrees and ideally 1.5 degree scenario, they also need to be, let's say, included, but they don't have yet, let's say, zero emission technologies available. So Itamar talked about shipping. There's just no electric or let's say ship that can go long distances with really sustainable fuel.
And then, so hearing these variety of sectors, I understand also that Sustainalytics has different ways of analyzing. Maybe you could give us a little bit of a highlight about the difference when we're talking about a certification or a second opinion. What are the differences there?
Yeah, sure. So a certification is really verifying the alignment with a particular standard. So that is, for example, when we talk about the Climate Bond Initiative, they have several sectors that they looked at. They identified what are the technologies, what are the thresholds that are needed to align with a 2 degree or below 2 degree scenario, ideally a 1.5. Certification is really verifying it meets that threshold. There's no wiggle room. It needs to exactly meet that requirement. Same will be with once the EU Green Bond Standard is coming out, it will be you need to meet the taxonomy or not. Otherwise, you cannot be certified. Now, the opinion, the second party opinions that we also provide have a bit of a different take on that because they are an opinion. So we here obviously also use our internal taxonomy to see what is green and what is impactful. But there are, let's say, cases where we say, well, this has a little bit of a shortcoming. We still consider it to really be impactful, but in the opinion, we have the room to voice this, let's say, concern, but saying we still find it impactful. For us, it still makes a cut to green, even though it has certain limitations.
And thank you for that, Lili. And I keep on coming back to my initial thought, you know, how green is green, because I think everybody listen to this webinar have potentially also different greenness view on what is green. So when you look at a bond, you know, how far do you go into the underlying company issuing the green bond? Do you only look at the bond finances and the proceeds, or do you actually look into what the company is doing?
Yeah, that's a great question, and that is actually a topic that has been becoming more prominent over the last year. How does actually the sustainability strategy of the issuer look like? And in our second party opinions, we do look at at several aspects. So obviously the alignment of the green bond principles as a baseline and our internal taxonomy. Look at the issuer strategy and their risk management towards, let's say, environmental and social risk for the projects that they're financing. And obviously, let's say then an SDG alignment as well, so sustainable development goal alignment. Within this assessment of the sustainability strategy of the issuer, what I do need to mention here is that the green bond market is broader than just pure plays. So the green bond market really includes companies like Itamar mentioned, like Coca-Cola Mexico. So there is the room to have issuers that are just at the beginning of their journey. And there is the room for those that are already completely there, that really their business model is based purely on, let's say, a green solution. And so what we look at in the second party opinion is how far is the company in their sustainability strategy. And yeah, that can be that they are at their beginning. It can be that they are already busy with sustainability since a couple of years. Can be that they have already set target or improvements over the last time. And it may be that they are a pure play, right? But there is, let's say, this, quite of a broad range of companies that can fall in there. Obviously, Sustainalytics, we also have a baseline as to what we consider a credible issuer. So it may be that we see when we, before we start a project, that we see that there is a big controversy associated with that company in the area where they want to, let's say, finance the projects. Then that could be a reason for us to say we don't consider that that is a credible green bond issuer, and we in that case would not provide a second party opinion.
This is obviously a very sensitive issue, and I'd like to hear also Itamar on that. You know, Itamar, when we talk about sustainability, ESG solution, and versus, you know, a complete green solution and impact investing, where do you see it from your end?
On our side, obviously, both are very important. So both the ESG strategy of a company and their actual impact is important. What we do here is we focus. I mean, we make a clear distinction between those two, and we seek to invest in companies that actually provide a positive impact further than and go further than just implementing some environmental strategy into their company. So I would say that's how we make the difference between impact and ESG.
Thank you. Now looking a little bit more with a critical angle, Lili, what are the main critics and the limitation of the second opinion or certification of green bonds? You know, and what are solutions do you see being developed to address these critics?
Yeah, sure. So I think one question that has been in the green bond market ever since it was born is obviously the question around what is green, what is not green. And are we achieving, let's say, with this instrument to make a difference in the world, right? Are we, let's say, moving a market towards being aligned with Paris agreements or not? And that is a discussion that will always, be there, because there are continuously new sectors moving into the market. There's continuously new technological developments. And so one of the, let's say, the critics that we saw was that, well, it's nice that there are all these green projects that are pure green, but actually really to shift our economy, we need to include those sectors that are hard to abate. So I've already alluded upon, let's say, what we call transition finance. So there has been a big push actually in the market from also the investor side to include those transition sectors under the umbrella of green bonds. And we see that the EU taxonomy includes a transition label. We see that the International Capital Market Association has just released a handbook on transition issuers. What do they need to fulfill? But so that has been, let's say, one criticism, and the push for for that also to be included was also very much led by some of investors. So we saw AXA Investment Management playing a big role in that push. The other critics that we see is actually that while it is great to have a promise that the proceeds are allocated towards green projects or matched towards green projects, do we really see an improvement in these companies? And we don't always see that, right? So there is, these instruments really go that far that you say, all right, the money is spent or allocated towards green project, but it doesn't really give you a guarantee that that company is further improving their sustainability performance. And this is where a relatively new instrument comes in, which is the sustainability linked bonds. It's super new, like the principles have been released only in June 2020. But the key difference here is that it does not include a commitment towards allocation of proceeds, but it includes a commitment to make broader sustainability improvement. And actually the bond or structure, the financial or structure characteristics of the bonds are linked to this commitment. So there's a predefined target by the company saying, for example, we are reducing our carbon emission by 20% within 3 years. And then there is a link to the coupon rate, whether that target is met or not. So that is one aspect, how this shortcoming is then being picked up by the market with another solution. I think both are trying to address different needs. Ideally, they would be combined, I think, to really achieve the highest, let's say, impact that that is possible. But yeah, that remains to be seen how many are going for a combined approach and how that develops over time.
With the shortcomings, we're coming to a very interesting topic, and I see some questions coming here as well, which highlights the returns. Should we see a difference of return between a green bond and a non-green bond, let's say, with the same credit rating and the same maturity? What's your take on this? And
well, the question whether we should, that's obviously, let's say, depending on the perspective. Obviously, companies do want to issuers love to get that. I think from the investment side, that may be, let's say, a bit of a different view. However, what we do see, let's say, increasing evidence of a greenium. That does not mean that every green bond, let's say, that issuers get better pricing for it. We saw in the very beginning, we saw a lot of anecdotal evidence that there may be, let's say, an advantage for an issuer. We do see that becoming stronger, but it's still not the case for every green bond that really we can say on a consistent basis there is a greenium for an issuer.
The greenium, I like this term, is the greenium potentially already addressing the default risk of the company, or are we talking about overall less risk? It's a little bit difficult, no, to define.
Yeah, absolutely. So we are also not doing any assessment of the financial characteristics of a company. So that's really completely outside of our scope, what we look like. The greenium could be evidence for the fact that, let's say, that company is obviously looking into sustainability. It is willing to really dedicate finance to that. So there may be a reduction in risk on that side. May also be that it's, I mean, the demand for green bonds is higher than the supply.
I understand fully this theoretical greenium. I would like to hear a bit more, Itamar, on the work you've done and the research. How obvious is this greenium, and what is your view on it?
Yeah, so just to go back a bit to what Lili mentioned, from what I've seen, the studies that have tried to discover whether there is a significant difference in yields of normal bonds compared to green bonds, I think there was no statistical significance. So yeah, I think it's mostly anecdotal. But I would still see it as I mean, if a green bond issuer is really credible in their strategy, I think it's also a signal that there is less risk in the future that you may invest in stranded assets. So that would be hit by regulation or the market overall. So I think that there's a risk component to it as well.
Excellent. So we do see this movement potentially coming a little bit more with time and depending on the companies and the sectors, which leaves a little bit of market inefficiency still occurring today. Excellent. Then I'm just looking at the time. We're going relatively quickly to this half hour. There was another questions maybe which we partly addressed, but maybe Lili, you can have another go at it. You know, we see bonds moving quite a lot, not just in climate. You know, I mean, and the biodiversity, the ecosystem. Are these called green bonds, or would they be called social bonds, or both? Or maybe what would be your definition around this?
Yeah, great question. So the green bonds are generally broader than only climate. Climate has been obviously, because of the urgency of climate change, has been very prominently, particularly also when it comes to the climate bond initiative that really focuses on that, and the focus of the EU taxonomy at the moment on these climate issues. But the green bond market is broader. So we have seen bonds that have been focusing on biodiversity or broader ecosystems. We have seen issuers that really focus on restoration of landscapes or putting in place measures that serve biodiversity conservation. Now we have different labels also under the green label, and that can sometimes be a bit confusing, because there's also something out there like a blue bond. Blue bonds are trying to address marine ecosystems, trying to finance projects, measures that can improve ocean health, but also broader going into, let's say, waterways. They still fall under the green label, but it is, let's say, more a strategy of the issuer to highlight with the name of the bond, this is really focused on water, but it still falls under the umbrella broadly of environment.
Excellent. Then maybe a last question, because I remember Itamar presenting this chart where you see bonds which are not rated. Do you have a comment on the company who do not want to have a second opinion or don't make this extra effort? Obviously, there's a small cost associated to it, but you know, besides that, what does it tell you?
Yeah, well, that's absolutely up to the issuer. This is a voluntary, a voluntary label. It's not obliged to get a second party opinion, even though it is recommended. I mean, obviously, let's say the service that we provide is an additional assurance that somebody else has looked at the project, see, okay, they're credible, what are the shortcomings? It may be that, let's say, those that don't go for a second party opinion, sometimes they may be pure plays and they just say, it doesn't make a difference for us. Everybody knows we're just working on this one technology. And that's fair enough, right? That's absolutely fair enough. Obviously, the green bond principles comprise more than that, really looking at also the management of the proceeds and reporting. But yeah, in that sense, it's up to the issuer.
Thank you, Lili. I'm just looking at the time, which is 5 minutes past half. I think we are going towards the end of this webinar. I don't see any other questions here that we would not have covered. So remains me to thank you all. I hope you could find some valuable insight into this webinar today. Thank you very much, Lili and Itamar, for joining me in this half hour. And I think as a quick reminder to all of you, we'll make a small wrap up and a small 2-pager of this webinar that we'll distribute in due time. And I can only welcome you to our next seminar, which will take place in a couple of months. And hopefully we can see you there. So have a great day, everyone, and goodbye.
Thank you.
Goodbye.
Bye-bye.
Thank you.